Knowing you are on track with your money is a great feeling, and now is the perfect time to start working towards financial security. Have you set your financial goals? Being in your 20s is an exciting time. You finally have the freedom to set your own rules and you understand the value of independence. However, a big part of independence is being able to support yourself financially. Hey there, welcome in the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. Today, we are talking about 10 financial goals to achieve before you're 30. So let's get into it. Number 1. Have a retirement plan. In your early 20s, income tends to be tighter and retirement might seem to be a far way off. But by the time you hit 30, you should already have a handle on the basics of retirement planning. After all, before you know it, you will be hitting the big 4 to 0 and beyond. If you have not yet familiarized yourself with the essentials of retirement, it would be prudent to do so immediately. There's no fallback plan if you realize too late you don't have enough money. Financial institutions may offer loans for various things such as education and housing, but they don't offer a retirement loan. Loans for various things such as education and housing, but they don't offer a retirement loan. Number 2. Pay bills on time. By 30, you should be able to pay your bills in full and on time, be it your utilities or outstanding debts. This is important as it will affect your credit score, which is used by banks to determine whether to lend you money in the future or not. Improve your credit score while you still can. Aim to pay off outstanding high-interest debts, starting with your credit cards. Then you can focus on higher purchase and student loan debts, personal bills, and so on. Number 3. Create an emergency fund. Set up automatic installments that make regular contributions to a contingency savings account. To begin, set aside a small portion of your salary, then gradually increase your savings target as you gain confidence or earn more. And before you ask, no, it's not a good idea to use your credit card as your emergency fund. By 30, it's essential to maintain an emergency reserve in the event of unexpected expenditure. Such a fund should ideally cover 3 months of living expenses, although this would vary depending on your circumstances. Number 4. Track your spending. Knowing how much you spend and what keeps your spending in check. Where is my money going and how can I control it? You might discover that ordering food several times a week costs more than $300 a month, or recurring charges for streaming services and subscriptions you never use are a waste of your hard-earned money. If you can afford to spend hundreds a month on ordering in, great. If not, you've just discovered an easy way to save money in addition to canceling those streaming services you forgot you had. Number 5. Live within your means. Keep your standard of living below what your earnings can accommodate. As you advance in your career and gain more experience, your pay should increase. But rather than using this excess income to buy new toys and live a more luxurious lifestyle, the best move is to put the money toward reducing debt or adding to savings. Save as much money as you can. If the cost of your lifestyle lags behind your income growth, you will always have excess cash flow that can be put toward financial goals or an unexpected financial emergency. Number 6. Don't borrow to finance a lifestyle. Borrowing is a curse and should be avoided as much as possible. Borrowed money should be used when your gain will outrun your borrowing costs. This might mean investing in yourself for your education, to start a business, or to buy a house. In these cases, borrowing can provide the leverage you need to reach your financial goals faster. On the other hand, using credit for a lifestyle you can afford is a losing proposition when it comes to building wealth. And the added interest expense of borrowing further increases the cost of the lifestyle. Number 7. Set short-term goals. Life holds many uncertainties, such as an economic crisis or the loss of a job, and much can change between when you are in your 20s and say 40 years later when you may retire. As such, the prospect of planning far into the future can seem daunting. Rather than setting long-term goals, set a series of small short-term goals that are both measurable and precise. For example, paying off credit card debt within a year or contributing to a retirement plan with a set contribution each month. If you set goals, you'll have a better chance of achieving them. Number 8. Become a homeowner. The cost of a house down payment when your career is young can seem unachievable, but becoming a homeowner in your 30s or even buying a house in your 20s could be a smart investment. And it's not as difficult as you think. One way to start saving money would be to take any cash you save from refinancing student loans or consolidating credit card debt and set it aside for your down payment. If you've already learned to live without that money, it could be a relatively painless transition. Home Buyer's Guide has even more tips and advice to help you get started. Number 9. Invest in yourself. Look at yourself as a financial asset. Investing in yourself will pay off in the future. Your skills, knowledge, and experience are the biggest assets you have. Increase your value by continually upgrading your skills and knowledge and by making smart career choices. Though this investment often starts with going to college or a trade school, keeping skills up to date and learning new ones that are in high demand can help make you a more attractive and higher paid part of the workforce. Investing in yourself should continue for your lifetime. Number 10. Find the right balance. Striking a proper balance between your life today and the future is also important. Financially, we can't live as if today is our last day. We have to decide between what we spend today versus what we spend in the future. For example, set a short-term goal to save for a trip to a destination you've always wanted to see instead of using a credit card to finance it. Finding the correct balance is an important step toward achieving financial security. So guys, all for today's topic. See you soon in the next video. Goodbye.